Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, over the past couple of weeks, we have extensively discussed and given inputs on numerous topics related to your insurance policies. But today, we will discuss the top 10 myths that exist about insurance in general. Now, these fallacies or half-truths or assumptions confuse the most knowledgeable of us into buying policies that do not suit our particular profile or need. To help decode these myths, we have with us Yashish Dahiya, CEO and founder of Policy Bazaar. Welcome to the show, Yashish. Now tell me, one of, I don't know whether to call it a myth or a fallacy, that, insurance is a tax-saving instrument. In some ways, it is right.
To an extent, insurance is a tax-saving instrument. The problem is when it becomes only a tax-saving instrument, then you got an issue because there are other tax-saving instruments. So PPF is also a tax-saving instrument. Employee provident funds are also a tax-saving instrument. And both these tax-saving instruments work pretty much the same as insurance in the sense you save money at all 3 points. So the only reason you would buy insurance cannot be tax-saving. And I think that's where this fallacy is very critical. Because the primary reason you would buy insurance is for protection. Protection against death, protection against disability, protection against severe illnesses, critical illnesses, and protection against basic illnesses, to build a pension corpus, to take care of children's cost when children grow up. These are the 5-6 reasons why you would invest in insurance. Also, there are assets you may have. You may have a car, you may have a home, and you need to insure those contents, so you need to insure your assets need to be protected. But that's what insurance is for. Insurance is not about making returns over a medium term by saving taxes. If that is the intention, there are other instruments which will prove far better. You can vouch that fixed deposits will themselves prove far better over a short period, over a 5-year to 10-year period. Fixed deposits will almost always beat insurance plans. Also, your mutual funds over a very short period will beat insurance plans. And PPF and employee provident funds will also do that. Where insurance comes in handy is building corpuses over a long period of time, 20 years, 25 years, and in providing protection for all those pieces that I spoke about.
So basically what you're saying is that the tax-saving incentive should be looked at as another positive rather than the primary point of...
It should be, so the tax saving, because people think so little about insurance and because it is so critical to keeping society running, government has provided tax incentives for people to invest in insurance, whether it be life insurance, whether it be health insurance. And people have to see it from that perspective. I want to buy insurance. The tax is an additional incentive to do so.
Right.
One shouldn't, usually what happens is come 31st of March or whatever, there's a huge horde of people who are saying, oh, I have that 1.5 lakh rupee 80C to save money on. So where do I go? The first product they find is insurance. And that's primarily because the insurance agents are everywhere. There are very few agents who are selling PPFs or employee provident funds or mutual funds or fixed deposits to you. So even if you go to the bank doesn't tell you about the fixed deposit. It tells you, no, please invest in this insurance plan because they make more commission on that. So everybody is trying to push that to you, and that's the easiest one to get. So you just go and get an insurance plan. That is where the consumer loses, and eventually the consumer does not get the product he wants. So in 3 years' time, most of the people leave that policy. So that's what a consumer should not do. A consumer should think about what he's buying, why he's buying it, what it's protecting him against, and then of course take the advantage of tax. I'm not saying don't take the advantage of tax. Take the advantage of tax. That can be the primary reason to buy.
Right. And, another common misconception and the way we motivate ourselves to buy insurance policies is to say that, all right, let me buy an insurance policy in the name of my child or my wife, because after all, an insurance policy that I'm buying is actually for them. Is that the right thinking?
Oh, no, that is certainly not the right thinking because the insurance policy, if it's a life insurance policy, definitely should be bought in the primary earning member's name. The individuals who are supposed to get the benefit of that policy, or the individual whom you would like to be the custodian of that policy's benefit, is usually called the nominee. So the individual who is the primary earning member takes the policy in their name and nominates the responsible person in their family or whoever they want to make sure that the funds are distributed well amongst the other members. That's how it should happen. They should certainly not take the policy in the name of the person they want to get the money, because in life insurance usually In the worst case, what that policy is for is actually for making payouts when the individual is not there, not to give funds to the same individual. That happens in case there's a fortunate event and nothing unfortunate happens, then the money comes back. That's how a life insurance policy works.
Well, now, a lot of people who are working in companies get the group insurance plan from the company.
Yes.
And so the feeling is that, I'm already covered. My healthcare is probably taken care of. I have a certain amount of life insurance there.
Sure.
Now, is that enough? And people actually don't buy more insurance to protect their families because of this particular reason.
Let's talk about, let's understand three basic facts. The first fact is most medical costs are going to come after 60. They're not going to come before 60. They're mostly going to come after 60. The second piece is 70% of all medical costs in the world are for what you call diseases which have happened, which are such in nature that every year you will have an expense. So diabetes being one, heart disease, heart ailments being one. So once that disease happens, the expense is going to come every year. Right? I think the third element is your corporate policy is not going to continue post-retirement. Or even when you change a job, it won't continue. If you look at these three, a bulk of your medical costs are going to come when this policy will not be usable. So you might as well have an individual plan, because that individual plan is the one that you will be able to keep. The second part is, if any of these diseases sets in before you have retired, now most of these diseases actually for men set in about 40 to 60, many of them have now started setting in even from 25. So they've started setting in really early. So if any of these diseases set in, after that nobody's going to give you insurance. Nobody's going to give you meaningful insurance, because no insurance company is going to be,
they're not going to take the risk.
Why should they take on a known cost? It's not a risk any longer. Insurance companies are very happy taking on risk, but they will not take on a known cost. When it is a guaranteed known cost that every year there's going to be a cost of 30,000 rupees, why should the insurance company pay that 30,000 rupees by taking 10,000 rupees from somebody? Like nobody would, right? So once somebody knows a disease is set in, nobody's going to provide insurance, so very few people will provide insurance. So you've got to take the policy before them. Hence it makes sense to take the policy early and take an individual policy. Now there may be a fear that, look, why should I pay double? My company is already paying. So there are these plans called super top-up plans. Now how a super top-up plan works is, you've got your company cover, let's say you're covered up to 3 lakh rupees. That cover will only kick in after the 3 lakh rupees is over. And that cover is very, very low cost, and it can go up to 10 lakhs, 20 lakhs, 25 lakhs, 30 lakhs, whatever amount you want. And the cost of so let me give you an example. The cost of a 5 lakh policy, a 5 lakh rupee policy, is probably more than the super top-up cost from 5 lakhs to 25 lakhs. So super top-up plans cost quite low. So one can go in for a super top-up plan. Some of these super top-up plans have a mechanism by which when you retire, they can automatically give you the first 5 lakhs cover. So that can be your one mechanism of having your individual super top-up plan and then coming into the fold of the normal Medicare plan. But I think you have to really think about what happens post-retirement. That's why it's critical that one has their individual plan.
Right. Now, a lot of young people, and I've heard them say that, and even bachelors, people who haven't gotten married, don't have families, say, I really don't need insurance. After all, I don't have dependents, I don't have anybody to look after. Why should I spend money on insurance? So
Sure.
What do you say about that myth?
So see, when I spoke about those 6 things that you have to worry about, see, everybody worries about their car. If they have a car or a bike, they have to get it insured, they know about it. If you don't have a home and assets, people think about it. But those 6 pieces that I spoke about, let's stay on those. Death, disability, critical illness, normal health, pension, and child plans. At least 4 of them, disability, critical illness, health, and pension, apply to an individual, not to his dependents alone. Because it's only in death that the money goes to the dependents. In all the other cases, the money goes to the individual. And the individual needs, if there is a critical illness that happens, you don't need dependents. You have to take care of yourself, and hence the money will be required. If a disability happens, you need to be taken care of. So one doesn't need to worry about dependence at that time. You become the dependent effectively, and hence you need the monies. And in the case of a health insurance, you have to have a health insurance, whether you have dependents or don't have dependents. If you need hospitalization, you need to take on the cost. Either you pay for it yourself or the plan pays for it. And We are all hoping all these unfortunate events don't happen and you live a very healthy, long life, in which case you will require a pension. So insurance you would require with or without
Either
dependents.
way, one needs to look at
But yeah, life insurance per se, you may not require till you have dependents. That's a very fair point. So I would not recommend an unmarried individual whose parents are not dependent on him or her to take a life insurance plan.
Right. All right. Now, a lot of, term insurance is gaining in popularity, but a lot of people say that, it's not linked to any investment plan. It's not linked to any return. I'm going to keep giving it. I won't get any returns in over the years. So I shouldn't really take a term plan. So what do you say about that?
Let's talk in very simple terms. Let's say somebody was investing this 1.5 lakh rupees.
And term plans are pure insurance.
They're pure insurance. They're pure life insurance, right? But let me talk in commercial terms, because that's a commercial question. See, the fact is people want life insurance, but they're saying, hey, I don't get returns, so how does it work? So let's take a very simple one. If you have to invest 1.5 lakh rupees and you took that 1.5 lakh rupees and you broke it into two pieces, 1,40,000 and 10,000. So basically you took out 6.7% of 10,000 on 1.5 lakhs is about 6.5%, 6 to 7%. You took that amount and one bought a term cover of 1 crore rupees, which is roughly what a 25, 30-year-old person would get. For the next 30 years, they will keep investing this amount and they will have that cover. If they took the same 1,40,000 rupees and now invested it in the best possible investment vehicle, whether it be low-cost tulips, whether it be mutual funds, whether it be PPF, I can guarantee they will get a much better return than if they tried to combine this term insurance with the investment and somehow tried to buy a plan which would give them a 1 crore cover and would keep taking this 1.5 lakh rupees every year. And it'll give them some return in the end, but that return will be much lower than what they will get from the 1.4 lakhs that they will be investing. So because it's only a 6% gap, and most of the very strong investment vehicles will beat the insurance plans by at least 20-30%, not by 6%. So the advice would be separate these two as much as possible. The only time when you combine them is actually in child plans, because in child plans it's necessary that that individual survives that duration, because if the individual does not survive, that money still has to be available. And there it doesn't work very well if you have a term plan and an investment plan, because if the child gets the money when they are 3 years old, that money will not be available when the child is 22. So child plan is the only thing that protects the amount and provides it at the right time. So child plan is the only place where you combine life insurance with investment. Everywhere else, keep them separate.
And, we are talking about myths surrounding the insurance that you end up buying, and we've got Yashish Dhaya with us. Yashish, I hear a lot of people say, this insurance plan is not expensive enough, it couldn't be good. So do you ascribe to that view?
I think one shouldn't judge it that way. Companies have worked very hard to innovate, to bring new products. I think the product should be taken at face value and should be understood. I think if a plan is cheaper, that does not mean it is worse, or that does not mean its quality is bad. It just means somebody has worked harder to get the consumer a better product. Now, there is a possibility that certain features have been removed. If that is the case, of course, and that you may find some of that in products like health insurance, but in very simple commodity product like a term insurance, because death is such a universal truth, it is just such a black and white event, you can't overcomplicate that product too much. So in that, if the product is lower, that doesn't mean it's lower quality, it's got the same promise. It's got exactly the same promise, it's just at a lower price. And the companies worked hard with their reinsurers to work this through. There's also this important piece, which I must just share with consumers. A lot of people are worried why these prices are coming down so fast. The prices are coming down because the reinsurers are very, very aggressive in India. The reinsurers are the ones who are reducing prices, not the insurance companies. The reinsurers are the ones who are underwriting most of these. So many companies have the same reinsurer. So it doesn't really matter whether you take from company A or company B, the reinsurer underwriting the policy at the back end.
So explain to our viewers what a reinsurer is, because now that you've used that term.
A reinsurer is the one who pays the claim, a bulk of the claim. So most companies, if you have a 1 crore cover, the company is going to pay between 5 to 10 to 20 lakh rupees of the cover. The rest of it is paid by a reinsurer. There are 5-6 reinsurers in this country: Munich Re, Swiss Re, Hanover Re. These are the people who provide these covers, and they are the ones who are underwriting. So you may have 4 companies with the same underwriter at the back end, with the same reinsurer at the back end. So if the reinsurer is the same, their promise to pay is pretty much the same, and it's dependent on them, not on the company. And hence the consumers should not worry too much about it. It's just about who's negotiated a better deal, who's done what. And the reinsurers are very hungry for Indian business right now because it's growing. And India has a young population, while most of Europe and the US have got an older population. So their portfolios are skewed towards older populations. What happens in older populations is pensions are being paid out. And in younger populations, people start investing. So they really want the younger population to balance out the older population right now.
Right. Now, one hears people say, oh, insurance is just too much of a hassle to buy. It's cumbersome. The process is long. Would you say that's a myth?
I think today it's a myth because you could go online and buy a policy within half an hour. It doesn't take more than half an hour. It may take you another 1 hour of research time. So our analysis tells us people who buy research for about 90 minutes. On something like our platform. So people would come, they would research, they would compare. So I think about 2 hours is a sensible time to buy a product which one's going to buy for a lifetime. But that's the only way people will buy the product that they think is right for them. So yeah, I think about half an hour to complete the transaction, about 1.5 hours to understand the products. You've got to invest that much.
Yeah, I mean, due diligence to that extent should not really, because after all, you are
20,
insuring your life or your family's,
It's the second most expensive product after a house. So most people do not buy a car which is as expensive as their insurance policy, because many people who are earning 10 lakhs and above are spending at least 1.5 lakh rupees on their insurance product every year. That is not the amount people even spend on their car at the same income bracket. The only thing they would spend more on is a house. Imagine how much time one puts into finding out what is the right house for them. And the way insurance is bought is somebody comes and says this is a good product because that person is getting a higher commission and actually nothing else. And the person blindly buys it. 2 years later he figures, oh, this wasn't what I wanted to buy, then leaves the policy. So let's get our maturity act a bit sorted on this side.
Right. Now, again, as far as young people, though I don't want to bracket them, a lot of them have credit cards now, and they say, oh, my credit card offers me insurance, so I don't need more insurance. Now, is that a myth that can be busted?
When was the last time you actually saw somebody getting a decent life insurance cover payment or a good health insurance payment, where the medical costs were taken care of through a credit card? So there may be some. See, how much do we pay for a credit card? 500 rupees? How can one get meaningful insurance in 500 rupees plus the benefits of the credit card? So no, I think they should focus on just getting their insurance product, not club it with the credit card, because that would usually not be insurance.
Now, a lot of people also limit the amount of insurance that they buy because of the ATC limit.
Yes.
And they say, okay, beyond that, I don't really get that tax benefit. Though we touched upon this logic is also used by people not to buy more insurance. Is that the correct justification?
So I've heard from a lot of people, I've hit my limit of ATC. I think on the first one we answered, the reason you buy, and when you then give you a portfolio of plans, so they'll have 7 plans, mostly some kind of money back, some kind of traditional plan, which they don't understand why they've bought.
Or even PPF and all that.
Or PPF. PPF, yes, of course. I think that's a wise choice, by the way. So the PPF is a wise choice. But once they've hit that limit, they don't think about insurance. Now, insurance was not about that limit at all. It wasn't about taxes in the first place. It was about your life cover. And they would have this 1.5 lakh rupees they're paying or 1 lakh rupees they're paying every year. And the total life cover would be 5 lakh rupees or 7 lakh rupees or 10 lakh rupees at most. And that is where they figure they actually don't have life cover. They basically are investment products which they don't know what to make of it. And you see so many people and they've lost lakhs and lakhs of rupees in this conundrum. I think it makes a lot of sense to, how much does term cover cost? 10,000 rupees. How much does health cover cost? 6,000-7,000 rupees, 10,000 rupees. According to me, in 20,000-30,000 rupees, most of your critical insurance policies are done. You don't need 1 lakh rupees. The remaining part, one needs to put forward for their pension. Now, if you really think about pension, I think people should be investing about 10 to 20% of their salaries in pension. Because if they don't, and I'm talking about a 25-year-old, if they're 40-year-old, they probably need to start investing 30%. If they don't, they won't have a pension.
With inflation indexation and
Absolutely.
the cost of living going up. And
so the rule of thumb is, at the age of 25, about 10% of your income might be able to get you there. throughout your life if you're investing 10% of your income, 10, 12% of your income. But if you're already 40 and haven't made a pension plan, then you probably need to invest about 30% of your income, 30, 35% of your income to have a meaningful pension. Otherwise, you won't have a meaningful pension. So, it's the individual's choice.
So what about, insurance and financial planning? Are they related in your view?
See, financial planning is about your goals and aspirations. Insurance is about protecting those goals and aspirations. Because you can make all the goals. You can make a goal that you got to buy a house, you got to buy a car, you got to live in a certain way, your children need to go and study somewhere, you want to have a happy retired life. Those are all goals. Those are all aspirations for which you do financial planning. But all those goals can go away if the earning member expires, if the earning member has a critical illness, if there is a big health scare in the family. And that is what you need insurance for. Insurance is for protecting your dreams, protecting your goals, because without insurance, those can be lost very quickly.
Right, Yashish, thanks a lot. That's all the time that we have on this show of Policy Bazaar. But do write to us at ask.policybazaar.com or tweet us at Twitter at policybazaar_in. And we'll see you next time with another episode of Policy Bazaar. Goodbye. Bye-bye.